Shriram Transport Finance, a company that also gives you a sense of what's going on with the macro economy. Joining me today, Umesh Revankar, the Managing Director and CEO of Shriram Transport Finance. Good morning, Umesh. Thanks very much for joining us. Let me start first by asking you about this new fundraise that you've done, 5,000 crores, I think roughly at a tenor between 9 to 9.4%. Talk me through what you're going to do with those funds and where or how does it impact your cost of funds at this tenor?
We had not come into retail money raising for some time, last couple of years, and we thought we should come this year. And the main reason for getting into the retail on such a big fundraise is to there is a huge lending opportunity now. We are roughly lending around 4,000 crores per month, and we felt that funds can be immediately utilized. So whatever the fundraise we have for this year, the demand seems to be quite good from the both urban and rural market, and we should be able to deploy it. And also the cost of fund, even though it looks little on the higher side, but if you look at the 3 years, 4 years back, whatever the funds we had raised almost at same price. So we are repricing at the same level. So it is not going to increase our cost of fund significantly. There could be around 15-20 basis point increase, which we would be able to pass it on to the customer because we are in a niche segment of used vehicle. And in the used vehicle segment, this can be passed on very comfortably.
All right, fair enough. Are you feeling any other pressure from market rates moving up at all? Not just for this 5,000 crore rupee fundraise that you're seeing, but any other access to funds? And do you've come back to the market after a few years. Is this it for now in terms of fundraise? Are you looking to do any large fundraising in the next, 6 months, 1 year? Does demand look that strong?
Fundraising from retail is one option we always have, and we are also deposit taking NBFC, so we also can raise deposit quite significantly, which we have been at a little low key in the last 1 or 2 years. So the retail access is very important, and yes, there are some pressure on raising resources because the liquidity is not as smooth as it was, and we would like to raise more and more. There are more opportunities to raise funds now, even from a masala bond and from the ECB source. So we are looking at multiple options, and we would like to keep all sources open at this time so that the growth can be funded much comfortably.
You don't see any impact on your net interest margins or anything like that, given the rising cost of money that we're seeing at this point in time?
No, net interest margin should not be a problem because net interest margin is at 7.5. We should be able to maintain it because we will be able to pass it on to the customer, because ultimately our borrowers being the niche, we are in the niche market of used vehicle, and I don't think around 15-20 basis point passing on is a challenge for us. So net interest margin should not be a challenge.
Okay. Can you give me more details on your growth outlook, since you sounded fairly bullish about it in your very first response itself? Where are you seeing the growth come in specific vehicle categories? I know used CVs is probably the biggest part of your business, but the specific growth categories, rural, urban, a little bit more color in your growth outlook?
CV sales have increased or peaked after nearly 4 or 5 years. 2012 was the peak sales. After that, CV sales were sliding down, and last year we saw for the first time it is crossing the 2012 peak. The demand is coming mainly from the infrastructure segment. Infrastructure activity, especially road building, is going on a very strong note, and that is giving a strong demand for infrastructure related construction vehicles and equipments. And the second most demand is coming from the rural market for LCVs. LCVs sale is required for redistribution and agri output. So agri output movement and the redistribution of the finished product happens through the LCVs, and the e-commerce activity also have gone up significantly. Another important thing is last 2 years there has been good monsoon, so agriculture output increase also has gone up. So increase agricultural output increase and the movement of that, and the increased consumption in the rural area, because the agri output and rural area economy being good has helped helped us in increasing our lending activity. And also demand in the rural market is always for used vehicle. So all this has culminated into a better demand for us. And I think it will continue for another couple of years, because this year also we expect good monsoon and infrastructure story is quite strong. So we expect good demand for a couple of years.
So what is the kind of growth you're expecting, for assets under management between now and let's say FY20?
We expect somewhere between 18 to 20% CAGR growth on loan book.
Okay. Some of the analyst reports one reads seems to suggest that in fact things may not go as smoothly as you expect, because there are certain headwinds building up in the space, right? For instance, whether it's the fuel price increase that we've seen over this last several months, or of course a well anticipated shift to better emission norm vehicles such as BS4 vehicles, and the efficiency that comes with those vehicles, that could then impact your used CV business substantially. What would you consider are the headwinds that could change your growth outlook for this year?
See, the advantage what we had was the post GST, after the state borders removed for the movement of the vehicle, the efficiency of the vehicles went up. That is the productivity of the vehicle. Instead of traveling around 250 to 60 kilometers a day, the vehicles are running around 300 plus kilometers, which adds 15-20% on the productivity of the vehicle. That has helped people to manage the increase in the fuel price. So I don't think that has hindered the vehicle sales, and we saw better demand in the month of March. Post-March, there was some lull because there was excess sales in the month of March, that's all. But I don't think the increase in fuel price has impacted the viability of the vehicle operation. And as far as BS3, BS4 or going forward BS6, that will not impact the used vehicle, because used vehicle are existing vehicle that will remain to continue to run, and it will change hand from one person to another person, and it requires a loan every time another person is buying the vehicle. So it is not going to have any negative impact on the used vehicle. But whereas what happens is when BS4 vehicle comes, or next in 2020 when BS6 vehicle comes, the new vehicle price will be higher because of the higher technology. The prices will be higher, and that will have an advantage on the existing used vehicle, because used vehicle price also goes up. So we have a better asset coverage. So every time when the new technology comes, when the vehicle becomes costlier, the existing used vehicle price also undergo a change and prices go up. So existing vehicle will not get retired or get scrapped. So it will keep running unless you have some scrappage policy. In the last couple of years, government was talking about 15 years vehicle, old vehicle being scrapped, or giving them incentive to scrap, but nothing has come. But whatever the latest government stand is that more than 20 years old vehicle would be scrapped post 2020. So government is giving enough time for the vehicle, for the owner of the vehicles to retire their vehicle. So I don't think there is going to be any challenge as far as used vehicle is concerned.
So you don't see any shrinking? You don't see any shrinking in the contribution of used vehicle business to your overall business?
No, we don't see, because what we have penetrated is much smaller. The overall organized players in the used vehicle market is around 35 to 40%. The rest is still with unorganized players. So there are still unorganized players who are lending to used vehicle. So we have enough scope and for growth.
All right. One last question to you, sir, and that has to do with, I think you said you expected loan book growth at about 17–18%. Your last quarter of the FY18, you did about 21%. So you're expecting a slight tapering off of loan book growth for FY19. Is that a fair understanding of the numbers? And your view on asset quality, because Q4 also came with a slight bump up in terms of, your GNPAs.
See, last year we gave guidance of 15 to 18% growth, and we grew 21, mainly because there was good demand for new vehicle. In the second half of the year, the new vehicle demand went up, and our existing customer, they upgraded themselves to new vehicle, especially in the north and east, where there was a bigger demand for new vehicle. And that helped us to grow at 21%. So this year we have given guidance of 18 to 20%, and we should be able to grow at the same at that level. So it is not that we are tapering off; it is actually we are continuing with the same growth objective. As far as credit cost or the increase in NPL is concerned, we moved from 120 days to 90 days. So as per the RBI change in NPL recognition norms, we have moved from 120 to 90, and that has increased the gross NPL to 9.15. And we had given the guidance to the market that it will grow by around 1.5% from 122, and we have almost maintained that. In fact, we have managed it much better, because we also have managed the demonstration and GST issue in between last 2 years as we move from 180 to 90. So I think we have managed it quite well, and there is a scope to reduce it in this year, because we have not really communicated to customer change in norms as far as the NPLs. And now we have started communicating to them, conveying to them that they need to be a little more disciplined. And we need to really appreciate the fact that most of our customers are individual and operating their vehicle for their self earning or livelihood. When they use the vehicle for livelihood, there would be some money which is earned on the vehicle diverted towards their personal need or emergencies or exigencies. So considering that fact, we have been very comfortably managing the NPL situation, and the credit cost, which is at around 3% now, should come down to around 2.5 level in the next couple of quarters. And monsoon being good, we are extremely confident both gross NPL level and the credit cost level would come down to a very reasonable level in the next couple of quarters.
All right, Mr. Revankar, we'll leave it there. Thank you very much for joining us this morning.